On the surface, the US housing market looks to be holding out quite strong, despite a prolonged period of high interest rates. The Case-Shiller Home Price Index continues to reach new all-time highs every month, and the median sales price for a US home is slightly lower than highs seen in the summer of 2022, but still far higher than prices seen in 2020. However, if we dig deeper, we can see that there is a lot of very concerning data around where prices could be heading in 2025, with a number of key forward-looking indicators flashing red and ringing the alarm bells that things are about to change. And it seems like the largest home builders and global financial institutions are starting to notice what is happening in the data and have begun to panic about what could be the end of a historic era for the housing market. Now, back in January, the Federal Reserve decided to hold rates where they are between 4.25 and 4.5%, with fears over reigniting inflation being one of the main reasons for the decision. This was a major shift in strategy compared to the 3 straight rate cuts that we had seen prior to this since September of 2024. And Jerome Powell did say in a news conference that we need to see real progress on inflation or some weakness in the labour market before we consider making adjustments. And now we've recently seen the latest CPI data come in hotter than expected, and it's looking like these inflation fears are starting to come true. CPI has accelerated once again, with the latest figures for January coming in above expectations at 3% on an annual basis and a 0.5% month-on-month increase, the largest monthly increase since August of 2023. And it is looking like this is going to have massive knock-on consequences on the housing market, specifically on the demand side of things, with how unaffordable mortgage rates are right now. Now, with CPI continuing to head in the wrong direction every month, the Fed can't afford to risk continuing with rate cuts, and they may have already made a mistake in cutting rates too quickly. Fed funds futures and betting markets are now predicting that there won't be any rate cuts now until September, and the odds of a second rate cut by the end of 2025 are just 31.3%. Now, all of this is very detrimental to home buyers as it keeps mortgage borrowing costs at sky-high levels, with no sign of these costs coming down anytime soon, and the market is on the verge of breaking. So the average 30-year fixed-rate mortgage now sits at about 6.7%, higher than the low that we saw in September last year of around 6%, which was a time when the markets were starting to think that we had got through the worst of it, with many people expecting rates to keep falling even lower. This has not been the case at all, and the 30-year fixed-rate mortgage rates have now been sitting above 6% for about 2.5 years. Mortgage rates remaining stubbornly high, last being this high in the early 2000s, and also exceeding the peak rate that we saw during the global financial crisis, does mean that things are still moving very slowly in the housing market, as many buyers just cannot afford these current borrowing costs. Now, this can be seen in the National Payment to Income Ratio, a metric which tracks the share of median income that is needed to make the monthly mortgage payment on an average priced home, which is currently at 33.5%. Home buyers are spending a higher portion of their income on average than at any point in recent history, and besides the peak of the global financial crisis, you'd have to go back to the 1980s to find a time when this metric sustained levels that were this high. Now, with mortgage rates being so high and buyers being squeezed to the limit on affordability, we are seeing 1 in 7 pending home sales get cancelled, which is the highest share during this time of the year on record. Just over 41,000 US home purchase agreements did fall through in January, which equates to 14.3% of homes that went under contract that month. This is up from 13.4% a year prior, and is also the highest cancellation rate for this time of the year since at least 2017, according to Redfin data. And existing home sale numbers, although off the lows that were seen in 2023, are still significantly lower than at any point in recent history. When we look at the Mortgage Applications Index for new purchases, it doesn't look like things are going to get any better anytime soon either, with this index still languishing at historic lows that are even lower than the bottom of the housing market crash in 2010. The fact of the matter is that housing affordability is literally the lowest it has been since the 1980s, which is contributing to why demand for houses right now has fallen off a cliff compared to a couple years ago. While demand reaches new lows, a reduction in supply on the market could help to offset this supply and demand imbalance in the future. However, there are a number of metrics that suggest that this is not the case at all, and we could in fact be facing a glut of supply hitting the market very soon, which would only make any potential upcoming housing market crash even more severe. The stock of new homes hitting the market from home builders is rising rapidly, and here we can now see that the total number of new single-family homes for sale is surging higher and higher, now at almost 500,000. This is now fast approaching the all-time highs that were seen in 2006, which was at the peak just before the housing market crash. And this does mean that overall, home builders are putting new homes up for sale quicker than people are actually being able to buy them, meaning that home builder stock continues to get bigger. And what is even more concerning is that the number of new homes that have been completed, meaning that construction has been completely finished, is also surging at an alarming rate. These are homes that home builders have failed to sell during the entire period of construction and still can't sell now that they are finished, meaning that they are now just sitting there empty with no buyers. And this influx of new supply isn't going to slow down anytime soon either, as there are still a whopping 1.4 million housing units still currently under construction at various stages and will therefore be coming online over the next few years as they get finished being built. Now, this figure has come down since the all-time high peaks seen in 2022 and 2023. However, it still is an extremely high number relative to the historic average, and it's very close to the peak that was seen just before the housing market crash in 2006. We really do need a big increase in buyers to match this supply coming from the home builders in order to keep the market at a healthy level, and this just simply cannot happen at today's average house prices. And it's not just typical citizen home buyers who are pulling away from the housing market, as we are also now seeing institutional home buyers and investors take a step back too. Two of the biggest publicly traded institutional home buyers, Invitation Homes and American Homes for Rent, are both trading at heavy discounts of 35% and 20% respectively relative to the net asset values of their property portfolios. And the gap between stock prices and net asset values has been widening since interest rates began to rise in early 2022, implying that investors think that the property portfolios are declining in value. Based on Green Street's analysis, the average house in the metro areas where Invitation Homes owns its properties may sell for $415,000, but the company's share price implies that investors only think that it is worth $310,000 on average. And a managing director at Green Street added, "Share prices are signalling that single-family home prices are too high and are not sustainable." And just in general, US real estate investors purchased 47,000 homes in the fourth quarter of 2024, down 3.9% from a year earlier, and also the lowest level for that time of the year since 2016. If investors continue to feel like the return on investment in the housing market is not where they want it to be, and keep pulling back from allocating capital into real estate investments, then this is going to be even less future demand in the housing market to further add to the supply-demand imbalance. Now, looking past the US housing market, the US economy on the whole could be under threat from the growing BRICS alliance, who are looking to become a new economic superpower to dethrone the US. Now, my previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, if you enjoyed the video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.